You finally did it. You crossed the threshold that was supposed to mean you made it, a six-figure salary. The standard advice has always been simple. Get a high-paying job, put a slice of that cash into a bank account every month, and you are mathematically guaranteed a comfortable, secure future. Yet your checking account tells a different story. You are taking home more money than ever before, but you are stretching every dollar just to make it to the end of the month. The cost to simply exist keeps climbing. The total at the grocery checkout line creeps higher. Your landlord adjusts the rent up another tier. The premiums on your health and auto insurance take a larger bite out of your take-home pay. A large salary can no longer outrun these costs. There is a continuous leak built into the system, quietly draining the value of your earnings before you even have a chance to spend them. Let's look at the moment you get a raise. For most of us, an annual bump in pay feels like a major financial win. Say your employer calls you into the office and hands you a 3% salary increase. You are officially earning more physical dollars this year than you were last year. This chart shows the hidden math of that raise. If the broader economy experiences a 5% increase in the cost of living at the exact same time, your raise isn't actually a raise. Your extra 3% is eaten entirely by the higher cost of goods, leaving you with a 2% deficit. You have a larger pile of cash, but those bills buy fewer things. This is the paycheck illusion. Your nominal income, the absolute number of dollars you earn, goes up, masking the reality that your actual standard of living is going down. We tend to think of inflation as the price of things going up, but it is more accurate to view it as the value of your money going down. Look at this diagram comparing identical goods. A gallon of milk that cost $3 a few years ago might cost $5 today. The milk didn't improve, the volume didn't increase. Instead, the purchasing power, the actual strength of your currency, has weakened. This weakness doesn't stay confined to the dairy aisle. It acts like a slow leak across the macroeconomy, simultaneously pushing up the dollars required to secure housing, pump fuel, buy food, and pay for medical care. Inflation is an active mechanism. It continually reprices the entire economy against you, making the cash you hold less effective with every passing day. If the cash in our pockets is losing strength, the logical reaction for many is to lock it away in a safe place, like a savings account. Let's look at a projection of static cash. Imagine placing exactly $10,000 into an account, leaving it untouched for 10 years. The absolute number remains $10,000, yet the purchasing power line shows the utility of those funds steadily drops. This loss of value functions as an invisible tax on anyone holding cash. The bank doesn't send you a bill, and you won't see a deduction line on your monthly statement. Storing your wealth purely as cash over a long timeline is not a safe haven. It is a mathematically guaranteed loss. People who consistently maintain and grow their wealth do not let their capital sit idle. They operate under a different set of rules entirely. The primary rule is simple. Cash is a depreciating tool meant for short-term transactions. For long-term growth, you must hold assets. This graphic illustrates the concept of an asset shield. Instead of cash, wealth is parked into ownership vehicles, real estate, shares of publicly traded companies, or direct business equity. Historically, as the dollar weakens and prices rise, the nominal value of these assets tends to rise along with them, often at a rate that outpaces inflation. One group holds cash that buys less every year, while the other holds assets that grow in value. This mechanical difference in behavior is why wealth gaps widen so rapidly during periods of high inflation. To actively fight back against inflation over the long term, you have to utilize compound interest. This chart models compounding in action. Your initial capital earns a return. In the next cycle, those original returns generate their own additional returns, creating a snowball effect. Look at the far right of the timeline. The real power of compounding requires consistent application. When you leave those investments alone and let them run for decades, small, routine contributions scale into substantial financial security. You move out of the anxiety of earning a high salary but feeling broke, and step into a position where your money is doing the heavy lifting for you. In a modern economy, a high income is a great starting point. But long-term survival isn't determined by the size of the paycheck you earn. It is determined entirely by how much of that cash you successfully convert into wealth-preserving assets.